On my mind, gotta hustle and grind. Financial literacy always on my mind. I'm stacking knowledge, no time to waste. Gotta invest smart, gotta keep up the pace. I'm reading books, learning all the tricks, studying the market, making calculated picks.
What's good, everybody? It's your boy Reckless Ravenero, and we are back at it again with another bag talk. Now, today we're going to talk about diversification, something that I don't particularly believe in. I believe in it strategically, but from the onset, I believe from a personal perspective and what I've seen financially, and every time that I've tried to start taking control of my financial situation, every time that I've started in the journey to actually building wealth, one of the biggest holdups for me, one of the biggest impediments for visible growth, and I'm not talking about get rich next Tuesday growth, but just visible growth within an ideal amount of time. Like if you have an idea and you're on the right side of history and you're on the right side of the trade, being able to see something within, 12 months even. And it's that I start off diversifying, which is, we always want to do what the wealthy do, but we don't have the context as to why they're doing what they do. So a lot of wealth conversations, especially when it comes to building wealth, generational wealth, all the buzzwords, what have you, revolve around, oh, you need to make sure you're diversified. You need to have a bunch of scatterblasted. So that way you're not losing what you got. And if you don't have anything, what you got really ain't that much to lose. That's actually probably when you want to be swinging for the fences. Again, not saying getting rich next Tuesday, but I'm saying being very focused, having a well thought out strategy, a narrative that you're going with, something that you're willing to bet your paycheck on. For me, that was Bitcoin. And once I actually consolidated and focused around Bitcoin and made that the focal point of my financial universe, which is to say that everything that I'm doing is to build up that Bitcoin stash even larger than what it is, because I feel that I've got my financial future secured. Like I'm over a Bitcoin within a reasonable amount of time. That in and of itself is going to do what it's going to do. With that said, enter high yield. We are starting anew. We're 12 months in, and the portfolio is starting to get to numbers where it's starting to matter to me. Like it's like, well, what if it all goes to zero? I'm like, I wouldn't be happy about that. So we're going to start down a path of how I am implementing diversification within my portfolio. Before we get into the conversation today, I want to make sure to give you guys a reminder to go ahead and hit that like button on the way in. If you've been here more than 2 times, or you're rocking with the boy, or you're ghost watching, go ahead and hit that subscribe button. And when you do not forget to hit that bell notification and turn all notifications on, so that way you can get these episodes as soon as they drop, first thing in the morning as they premiere. I promise not to flood your feed with incessant distraction. Lastly, another free way to support as we're flirting with that 400 sub range. Share the video, get me onto the algorithm. Now, let's go ahead and get into it. So what are we talking about today? Today is we're talking about how I diversify with WPAY. Now, being a part of the diversification gang, now I want to first off hit the logic as to the why. After I made a decision, it's a conscious decision, after we crossed the $40,000 in projected passive income, I was going to shift, as the foundation of my portfolio is high risk. It's high risk diversification, but it's high risk. It's the ulti position that I have, and I made that the base layer in all of my portfolios that are yield bearing. Reason being, it pays well, and it's inexpensive, which means that you get a lot of bang for your buck. It's also diversified, so that way they have the ability to switch out of positions if things go complete bedlam. That doesn't mean that they can get out of positions if the entire market's down, because they're not necessarily positions to get into at that point. We're in a downtrend. But I digress. It is risky. So as a foundational piece, I want to ratchet that back a little bit. My ideology was to just kind of ride Ulti until I couldn't anymore, and then disseminate that into other funds should it take a turn for the worse, which it has remained, from a total profit perspective, flat in my portfolio while producing income that I can deal with. So it's doing its job very well, in my opinion. For now, these are things that you got to watch. There's no free lunches. And it's got me at above 90% now with the recent market dip and NAF decline. It's kept its payments consistent at 9 cents. I based my position on it being an 8-cent payment, which was the worst that I'd seen it pay. They've been doing a good job in that respect, giving some stability. You know, when the market's up, we're sitting at a dime, which is awesome also. But I don't want to have all the eggs in one basket, and that is the predominant holding in my portfolio. So like if I go take a look, when I say dominant, Ulti is 53.43% of my portfolio. And what we're going to do is I'm not going to trim the position just yet. We've got just over 4,000 shares, which is, you know, once we get back to the dime bag era, when the market's up, that's going to be sitting pretty. What I am doing is, as I am disseminating, dollar cost averaging this money that I have from my loan into the market, which I believe I have 2, maybe 3 more payments coming in. We will be doing a split between TSYY, and WPAY, because WPAY is what I'm setting up to be the next foundational piece of the portfolio. Again, we are still going to be running hot. Reason being, I want to be able to manage my debt and pay the maintenance on this loan. I've got 24 months. It's a 24-month game for me of being able to handle this loan and continue to pay off the debt that we currently have. Like I don't want to lose on anything. I want it all, and reaching for it all, nothing wrong with that. We take the shots. This is an experiment that I'm doing with my money. So now we're in a 24-month window, which will, by the end of this loan payment, put me at the end of basically about 3.5, almost 4 years in high yield, because we're using high yield to pay for this, which subsequently is paying for my new vehicle. We're going to do a split. The majority of the split is going to go into TSYY. We'll have a video coming on that as well, as I break down my positions and the philosophy on these positions. The WPAY is going to be next in line for the rest of that payout, that payment amount. Obviously, keeping our blocks position at 10% of portfolio value. So like as that comes in, we're doing it in $2,000 allotments right now. $2,000, which means $200 of blocks will be purchased to keep that in alignment. Our WPAY will be getting whatever we don't get into TSYY. So I'm thinking probably a 70-30 split for right now. So that way we can keep growing the TSYY position. WPAY will get 30%. It's gonna be sitting pretty doing that. The reason we're just gonna not buy Ulti for right now and those dividends are active and being used. So is TSYY. Blocks obviously is rolling back into itself until we get to that metric of having $100 a week in payments from Blocks, in which case we will start adding in STRC stretch to add in an active cash position. And stretch, as we finagle around those, I think probably quarterly we'll build those positions, and once a quarter we'll reevaluate to make sure that we're at that 10%. And if we are above our 10%, we're going to trim down out of stretch and actually deploy that within the portfolio to add to our income, because that's the goal of those two positions, is cash reserves. Also, Black Swans will have a 10% portfolio allocation. Obviously, Blocks will take a major hit of that, especially if it's crypto related. But we'll have that stretch position that's building also. And then, stretch also pays out monthly. So whatever we get coming out of that monthly will go towards knocking down margin. That'll just be margin payment at that point, and trimming it back quarterly to make sure we're hitting that 10%. Because as money comes in, as we invest, Blocks will be part of that purchase. So whatever we've got coming in, 10% or at least one share, I guess, will go into Blocks every buy, regardless of what we're doing, because I want to keep that cash reserve position active. Diversifying with WPAY, what that does is it's less volatile, a little bit less volatile than Ulti is. A little bit. But it also pays up there. So we're going to go take a look at WPAY. Let me go ahead and bring that to the screen, and we'll have a conversation about that and kind of jump into the weeds on some WPAY. So the overview states clearly that the Roundhill WPAY Universe ETF seeks to track the performance of the Solactive Roundhill Weekly Pay Universe Index. WPAY is designed to invest in the eligible Universe single stock weekly pay ETFs. Why WPAY? Obviously, weekly distributions. That's what got us here. WPAY pays distributions every week, offering recurring income stream for shareholders. That's what we want. We want the income. The diversification aspect is point number 2, which we just talked about. WPAY offers diversified exposure to the entire suite of Roundhill weekly pay ETFs. Now, I personally like that because, generally speaking, they don't all have bad weeks at the same time. It's one of the things that I like about weekly distributions is, like, you don't have every week being a bad week, but like this also gives me exposure to individual funds that I would normally not purchase of my own volition because they don't fit into my personal narrative. Point number 3 that they give is it is seamless. WPAY is rebalanced monthly to equal weight, which means you get an equal portion of every single fund. They rebalance it monthly. You got extreme runners that they do the swing trading for you basically on a monthly basis. Now, me personally, I would normally get in there. I'm looking at it daily after it gets X amount in position. But they do it monthly. The important thing for me is over here in this section, the distribution rate, which is 71.67% as of today, or as of September 4th of 2025. Now, the reason I dial in on that, I like that because it's within my new metric. So what we're doing is, as we cross the threshold of $40,000, and we're close. As we're sitting right now, the portfolio is projected to pay out $38,319.07 over the next 12 months. What we're looking at is getting that as that boost up towards $40,000. What we're looking for is, as we get close to that, we're going to start dialing back, because then my bare minimum will drop down to 70%, which is basically what I'll be looking at for whatever my base layer is going to be from that point forward, which is why I've selected WPAY as the focus for that. Once it's as we're getting closer to that goal of 60,000, we're going to dial it back. So by the time we get to 60,000, we'll probably be down to about 40,000 or about 50% as my standard. Now, 50%, you got a lot of options at 50% where you can put in things that are pegged to QQQ. Yield Boost has products that are around 50% yield that are even less volatile, that are tied to QQQ, that are payers. We can look at an option like that to start adding in towards that point. And again, it's not necessarily that I'm going to clip positions. I'm going to keep Ulti where it's at until it doesn't make sense anymore. Like if we start getting in the red, we hit 5 to 10% total loss. And that's following my total loss on the position. Then we will start considering removing some of that position then. But as it sits right now, we're going to keep those 4,000 shares and keep them working. There's no reason to not have that hard work and money. We're just going to shift what we're buying. So instead of dumping money into Ulti, when money comes in, obviously we're going to do TSYY because of the insanely high distribution at such a low cost. And it's been paying consistently. So like I've got no complaints there. It's my best performer in total profit loss. So now that we're in a little dip on that, I am still a believer in Tesla. I know it's not going away. It's also it also ties into the Bitcoin narrative because they hold Bitcoin. So it's got a beautiful place in this portfolio. I like that. It's tech, Bitcoin, future, AI, robotics. Love it. As I'm moving forward, though, once we kick that distribution rate after we get projected to about 40,000, after we hit that $40,000 mark, then I'm going to go, hey, we're going to switch this around and start buying WPAY. And then we'll probably start slowly adding in whatever that next step down. We'll be looking for something around 60% that is diversified, is pretty stable, isn't flopping all over the place, just completely nuking itself, because we want that volatility. That's what we're giving up the high distribution rate for, is reduction in volatility within the portfolio itself. But we're probably going to have a good stint where we're just full buying in, increasing that WPAY position. Depending on what the volatility in the market looks like, we might be selling off a little bit of that Ulti position, because we are over $250 a week on that position. So I do have some extra where if there is something that could be trimmed, I can trim that position. And TSYY will be in the same boat, where that'll be another position that'll be trimmable, because since it's paying so high, it's easy to put money there and stock up money there. So if we have some surges in Tesla and Tesla starts going on a steady uptrend where we start catching some NAV appreciation on that, then we also have the ability to start making some moves there as well. But WPAY, I think it's solid. The experience that I've had since I've started adding it has been great. We got to see it go through that horrendous dip back in October. And it performed pretty well. Like I wasn't actually too worried about it. Like I looked, and I had some other ones, like Blocks took it way worse because it was Bitcoin related. And Bitcoin and Ethereum went down, which is, a staple of Blocks. So like, if you don't understand the cryptocurrency market, that's a hard hold, because it did get down into a range where I was like, oh, if this was anything else, you'd be getting looked to clip, and people will be like, oh, but Ulti did terrible too. Not as bad as Blocks did, at least not from my perspective for when I got into Ulti. Like I understand that people bought at above $6 and their cost average is above $6, especially those of you who were buying in at the 10s. That's not the reality for me. I waited. So that's part of the reason that, you know, you have to, personal finance is N of one, like investing is N of one, because not all of us are buying on the same timeline. So I can talk from my perspective, but those of you who bought at 10, you have a completely different reality with most of my holdings because you bought at different times. And it's the same way where I can have an experience with a holding where I'm like, oh, this is garbage. I got ripped off. I don't like this position. I'm out. But it's because of when I bought. Now, you didn't buy there. You're having a great time with the same position. You're making money with the same position. You're willing to ride a dip with the same position because your dip isn't the same as my dip. Like, you don't sit here and look at your portfolio and go, oh, that's, you know, having a position that's down 30%. People don't like that. But the same person who has a dip that's 30% and you're down 30%, for somebody else, we're down 1, 2 because of when we did our buys. And that's not to say anything besides we bought in at a different time than you, but you have to respect other people's experience within an investment, because it is different for everybody, because everybody gets in these positions at different times. And these people who make these videos, like myself, are telling you from our experience, from our perspective. We can give you our numbers, those of us who give receipts. That's not even everybody. You got plenty of armchair quarterbacks out there who just make video content because they know if they slap WPAY or yieldmax or Granite shares or roundhill on a post, you're going to watch it. And they're making their money from YouTube. This is a non-monetized channel. So I'm not incensed to do anything but give you my experience, because I'm definitely not giving financial advice. This is entertainment at best. And I'm giving you my context from my situation as a, you know, blue collar worker who's just out here doing stuff with no piece of fancy paper that says I'm smart, but somehow I'm worth more than a lot of people based on the averages. So until next week, I think we're going to close it out there. This has been another Bag Talk, talking about how I'm diversifying with WPAY, further diversification for the portfolio. And yeah, we will be back next week. Do not forget to hit that like, share, and subscribe. All free ways to support and help grow the channel on your way out. And until next week, people, it's your boy Reckless Ray and Narrow, and I'm out.
Money on my mind, yeah. Focus, got no time for games, nah. I don't play it, I'm all about that financial literacy. Investing in my future, building generational wealth. Dollar bills, they be calling my name, but I ain't chasing fame, I'm chasing change. Learn the game, now I'm playing it smart. Putting my money to work, it's an art. I'm stacking paper, building my own empire. No more living check to check, I'm getting higher. Investing in stocks, real estate, and more. Gotta secure the bag, that's what I came for.